Well, for more on the markets and that announcement from the Fed that's coming very shortly, let's bring in Scott Wren, Senior Global Market Strategist at the Wells Fargo Investment Institute. He joins us from St. Louis. Scott, great to touch base with you again. What are you expecting in 22 minutes from now from the U.S. Fed?
Well, Paul, I certainly don't expect the Fed to do anything with rates, so we're not expecting a cut. I will say we are expecting one this year. I think probably the earliest that's going to be is September. But of course, the press conference, I think, is what people are going to be paying attention to. And I don't really think that Chair Powell is going to give too much information other than saying, hey, it's uncertain. We don't know what tariffs are going to do to growth. We certainly don't know what's going to happen with the Middle East. And so I think that, I'm not sure really the market's going to get a lot more than what Chair Powell has been telling us lately.
You expect, you and your colleagues expect that U.S. unemployment will rise. The rate of unemployment will rise, and this will ultimately result in reduced consumer spending and likely a slower economic growth over the next half year at least. What will that mean to the Fed? That sounds like the type of environment that would provide the Fed with room to reduce rates.
Yeah, I think the Fed is going to have a tough decision. I think they're going to have to decide between inflation that's probably going to inch up a bit from here, and then unemployment, which is going to inch up a bit from here. And what we think is they're going to lean more towards the unemployment rate. So inflation's going to be higher than where they want to see it, but they're going to be more worried about the labor market. Really by the end of this year, we'll probably be close to 5%, 4.8% unemployment is our official call. So I don't know what the line in the sand is. If we see 4.5, 4.6 or something like that, that'd probably be a trigger for the Fed.
Okay, you've got you got 5 bits of advice for investors for the remainder of 2025, and they're very topical. We can show viewers what those are right now. Position portfolios for uncertainties, focus on quality and diversifying assets. I won't read them all right now. We'll return to the screen as we continue our conversation. But your first bit of advice is position portfolios for policy and geopolitical uncertainties. What exactly does that mean? There's certainly lots of policy and geopolitical uncertainty around right now.
There is. And so I think you have to try to stick with, we've used the term quality, which, let's face it, that could be vague. But in terms of equities, that means strong balance sheets, good cash flow, own their niche, have some pricing power, those types of things. So whether it's stocks or bonds, we're not reaching out and trying to pick up exposure in risky areas like small cap stocks or emerging markets. We just think there's too much uncertainty going on there. So we want to stick with large cap. We also like mid caps as well, but sectors like financials, energy, technology, communication services. We've recently added utilities, and that has, obviously some defensive qualities, but also utilities should benefit from really upgrades to the power grid, which we need badly here in the States. And then, of course, the build out just to meet data center demand from AI.
Okay, we'll bring back that screen. I think you've talked about number 2, which is focus on quality and diversifying assets. You also say right in the middle of this screen, viewers will see cushion portfolios with income generating assets. It is I'm reading from your note. You've referenced stocks and bonds. What more can you tell us about the importance of income generating assets? Does that include, for instance, dividend paying stocks?
It does. And, utilities obviously pay a decent dividend. Financials pay a good dividend. And we've been focused on the middle part of the yield curve. So, that 3 to 7 year span, you can lock in some decent rates. It's less sensitive to a move up in interest rates, which we think is, we're not expecting a big move up in interest rates, but over the course of the next year and a half or so, we wouldn't be surprised to see them up a little bit higher. So, once again, we want to earn some income. We want that to be coming from quality assets that even if the market goes down, which we're certainly looking for an equity pullback here, which we think is going to be an opportunity, we want to try to hold on to some things that are going to hang in there better than the more risky assets that are out there.
Okay, you want investors to have exposure to AI, artificial intelligence, but you want them to be selective about it as well. What exactly does that mean?
Yeah, I think when you look out and you look at the two big concepts that we've been talking about, artificial intelligence is one of them, and then very closely tied to that is industrial power. So right now, could you own a couple of the big names? Part of the Mag 7, of course, there's a lot of AI exposure in the Mag 7. Those stocks aren't cheap. I think for most people, if you can see some more pullbacks, we've seen a couple of decent pullbacks in the last few months in those stocks. They're back up to where they were. But I think beyond those big names, what you want to look at is baskets of these stocks. This is a lot like the internet was in the late 90s, where there's a lot of participants and there'll be some survivors, but not everybody's going to survive. So I think you look at whether it's an ETF, whether it's a mutual fund, you want basket exposure to AI. They're likely to have the big winners, and they're likely to have other winners that we aren't hearing about every day as well.
Okay, we're almost out of time, but you've mentioned pullbacks a couple of times, and your view is that investors should be ready and willing to buy quality assets and quality stocks on pullbacks. And you said that you expect a pullback coming before too long. Why don't we finish there?
Yeah, I tell you, really, let's face it, Paul, stocks aren't cheap. There's a lot of uncertainty out there. I think, you could have, whether it's these expirations of these 90-day tariff pauses, whether it's nervousness about inflation, whether it's nervousness about what growth, a slowing growth is going to do to earnings. We think there's enough uncertainty that we don't want to be jumping in and buying stocks here. We're pretty close to the all-time high. We think we could easily have, 5 or 10% pullback, which, 10% pullback, that's not a bold call. I mean, they happen pretty often. We've had a big run higher here. And so what we're telling our clients is know what you want to buy, be ready to buy it. And when if we get the chance and stocks are down close to 10%, step in and pull the trigger.